research started from the evidence of financial crisis, and especially the last financial crisis, well, I would say the latest, which from a macro perspective, we have evidence that there is a long-term cost of financial crisis compared with non-financial crisis. So maybe the present crisis, we don't know yet. And from the micro side, we have opposite versions. So we have the classical cleansing effect of crisis, but this positive narrative has been questioned, has been challenged by the literature that tends to say that during a financial crisis, you have credit frictions and the cleansing effect actually doesn't work, and it's rather a scarring effect. There is some literature based on the global financial crisis, some papers trying to see whether firms that are more fragile perform worse after the crisis as compared to firms which are less fragile. So this is typically the work of Romain Duval and others, and Semlem Kalemioskan and others. And what is common in these different papers is that they use a dummy for the global financial crisis. So it's a pre-crisis versus post-crisis, and it's typically a diff analysis. So what we argue in this paper is there is not such thing as a crisis, a global financial crisis. And here I show year-on-year GDP variations at a quarterly frequency for 4 countries. So the yellow line is the United States, and it's a very clean crisis in 2009. Whereas if you look at the orange and the gray line, which are for Spain and for Italy, we clearly see a second crisis coming in 2012. You could argue that the second crisis is not a financial crisis. So we should be interested in the global financial crisis itself. However, if you look at credit variation, so this is a year-on-year variation in credit to GDP in the same countries. The yellow line, again, is the US. So it's a very clean credit crunch starting in 2008, but peaking through in 2010. And then a steady recovery. Whereas Spain starts from very high level of credit growth and it plunges, but it's not specifically the global financial crisis. It continues up to 2013 and then stays at a low level, actually at a declining credit to GDP variation. And we have the gray line is Italy again, and there is a recovery up to 0, but we see that the low credit growth is not in 2009, it's rather later in the mid-2010s. And for France, which is the blue line, there is no credit crunch at all, except a very limited one in 2013. So our approach is to compare what happened with these 3 countries, European countries, which are all part of the European Union. So there's the similar structure in terms of financial regulations and capital flows, and same currency. So we concentrate on 3 countries that should be quite homogeneous. Spain, France, and Italy over 2000 to 2017. It's Orbis data at a firm level, and we concentrate on the intensive margin of GDP growth, of productivity growth. And we compare 2 different estimation strategies. One which looks like what has been done in the literature with a dummy strategy, post-2008 dummy, and another one which relies on country-specific credit constraints. And we compare the results that are obtained, like in the literature, with a panel of all countries, all 3 countries, and results with that are specific to each country separately. So our main results are first that so this is not a surprise, leverage has a negative impact on TFP growth in the three countries. However, those firms that have more leverage do not suffer more after the global financial crisis or when credit constraints tighten. It is the case in Italy, but only in Italy, not in France or Spain. So then we look more carefully at Italy, and we see that this specificity of Italy has something to do with small firms, but small firms do not show the same pattern in France and Spain. And perhaps something more new is that the fact that we relate the specific pattern in Italy with the fact that there is a large proportion of firms with short-term debt, so they can have a rollover risk, which will make credit constraints more tight for them and more binding. And this is not something we observe in other countries. So there is really a specificity in Italy, but more specifically, small firms with more short-term debt. So quickly about the data, as I said, we rely on Orbis data, and we recover TFP at the firm level through a quite standard strategy. We have three country-specific measures of credit tightness, which is the first one is based on ECB's business lending survey, where banks are asked whether the credit standards have tightened or loosened over the last quarter. Then we also use sovereign spreads, because we know that in Europe we have the doom loop, so bank spreads are correlated with sovereign spreads. And finally, we use a narrative approach of financial distress introduced by Romer and Romer. We control at the firm level. Of course, we have firm fixed effects, but we also control for sales at the firm level as a way to filter TFP for the cyclical effect. We introduce lagged cash flows and lagged leverage. But these two variables are introduced as a distance to the country sector size specific frontier, following Carlo and co-authors. Why do we do this? Because in general, firms with high leverage tend to be large firms, and they have kind of routine access to credit, and we want to control for that. So this effect doesn't matter if you just add these variables as explanatory variables in an additive manner, because we have these fixed effects that we control for size. But then when you interact leverage, which we are going to do, with measures of credit constraints, then you could have a biased effect. You could have a false effect of leverage, which would be, in fact, the effect of size. So our first strategy is based on a dummy. So here you have the log of TFP of firm I, sector S, country C, time T, or year T, as a function of sales, which again is a way to filter TFP. So there is no attempt to derive any causality here. Then we have a vector of firm level controls, which are leverage and cash flows, which are lagged, once for cash flows and twice for leverage. And then we have the post 2008 dummy, which is interacted with the vector of controls. And we add firm fixed effects and sector time fixed effects. So these are the results for the whole sample. I will then show the country by country results. So the first line shows that in all specifications, we have a pro-cyclical TFP, which is something that is expected. We have a positive impact of cash flows on TFP. So again, since we have fixed effect, this is the within firm time, so within firm, and as a difference with sector time averages. Positive effect of cash flows, negative effect of leverage. However, when we introduce the post-crisis dummy, then the negative impact of leverage is no longer significant, and the interaction is not significant either. So then what we have done is to replicate the same analysis with a different dummy, which would cover the euro area crisis. And we see that actually the interaction between this dummy and cash flows has positive effect, which means that after the euro area crisis, firms with more cash flow perform better, and firms with more leverage perform worse. However, when we move to the country-by-country results, we get exactly the same results for Italy, but not for Spain or for France. For Spain, actually, the interaction between cash flows and the post-euro area crisis is not significant, and the interaction with leverage has a positive effect, meaning that in Spain, firms with more leverage tend to perform better after the euro area crisis. Same for France. So our second strategy is to rely on country-specific credit constraints, which are denoted here with CC, credit constraint at country time. So it's a macro measure of credit constraints. So we introduce credit constraints as such, and then we interact them with the same vector of firm level constraints. So this is for the whole sample, and for country by country, of course, we have to drop the non-interactive measure of credit constraints. Otherwise, the estimations are the same. So we successively use the three measures of credit constraints. So these are the results for the whole sample. Again, we see the positive impact of sales on TFP, which is the cyclical effect. We have the positive impact of cash flows. We have the negative impact of leverage when there is no interaction. And then we have, so the first two columns are for our first measure of credit constraints. So when it goes up, it means that credit standards tighten. So we see that when credit standard tighten, there is less TFP relative to the firm average. And when a firm has more leverage, it's worse. So here we tend to confirm that firms with more leverage will perform worse when credit constraints tighten. Same with the second measure of credit constraints, which is sovereign spreads. Same with the third measure, which is financial distress. However, when we move to country-by-country estimations, again, we see that these results apply only to Italy, which are the last three columns, not to Spain, neither to France. So you may have noticed that we have more firms in Italy, and actually the average size of the firms is smaller for Italy. So it could be a result of a composition effect with more SMEs in the Italian sample. So we have rerun the estimation with only firms with less than 10 employees. And actually, the results are the same. We only get in Italy, so it's less significant, but we only in Italy do firms with more leverage suffer after when credit tightens, where financial conditions tighten. So we have tried to dig into the Italian case. The first idea was to look at firms with less or more than 15 employees in Italy, because there are labor regulations that offer more flexibility for small firms. So this would help firms to adjust faster when there is a crisis. However, there is also this zombie firm narrative. So we wanted to test for this, and what we get is that only in Italy do firms with less than 15 employees suffer more when they have more leverage, and this effect disappears when they have more than 15 employees. So it is something that is specific to smaller firms. Then we have looked at the maturity of the debt. And so we have separated the estimations for Italy for those firms where short-term debt represents less than 50% of the debt or more than 50% of the debt. And we see that only in firms with a high proportion of short-term debt, so only for these firms do we get the results, the main results, that more leveraged firms suffer more when financial conditions tighten. And finally, we have looked at the geographic difference between North and South, because we have read this narrative about Southern firms that could maybe perform differently, and the structures of the banks may be different. The governance of the banks may be different in the South compared to the North, but we don't see any difference.
2 minutes. Actually.
How many?
Two.
Okay, that's fine.
Thank you.
So finally, a few robustness tests. So we have first restricted the estimation to those firms with at least 10 years of presence in the sample, because it may be that our results would be driven by firms that enter or exit the sample, and this is not the case. Secondly, we know that there is a strong correlation between debt and collateral, because firms with more collateral will get better access to credit. So we have control for collateral, and it doesn't change the results for leverage. Although collateral is significant, but since it reduces the sample, this is not in our main estimation. And finally, we have control for reliance on external finance, following Rajan and Zingales index, and which was updated by Eikenhoven and others, and Panizza. And we do not find any significant impact of interactions with external finance index. So it's not true that firms with more reliance on external finance will see more impact of leverage during a crisis. So our conclusion is that more leveraged firms do not suffer more, except in Italy during a financial crisis. In Italy, it seems this effect seems to be related to the maturity of the debt and the size of the firm. And we think that these results are very important for the euro area, because these are key challenges of the banking union and the capital market union to make the channels of transmission and channels of credit more homogeneous across countries, in order for macroprudential policies and monetary policies to have a more unified impact on firms. And this is it. Thank you very much for your attention.
Thank you very much, Agnes. Very interesting, more policy-oriented paper, but very interesting. I enjoyed it a lot. I don't know if there are any questions from the panelists or from the participants. But I'll start then with a question for you. Now, I would have expected a different result. So I would have expected that the high leverage is a sign of fragility, unless firms that are very leveraged are firms that are better than the others, and then they manage to obtain better credit. And so essentially, we are hiding there with the measure of leverage, in fact, a quality of the firm, and the fact that the firm is a better firm, and so maybe we're hiding something. But I don't know, probably this was controlled by a fixed effect, so that should not disappear. So they're a little bit counterintuitive. For once, I think the Italians' results make more sense than those of the other countries, or am I getting it wrong?
Yes. So don't forget that leverage in itself has a negative impact on TFP in all countries. So this is true in all countries. What is different in Italy is that more leveraged firms suffer relatively more than other firms when there is a financial crisis. So this is the only difference.
But I would expect the same also for the other countries.
So this is not something that we obtain, and actually we have been looking for some theoretical explanations of that. Initially, we thought that maybe it was related to the ability of firms to obtain credit. So a more productive firm will, or a firm with good prospects in terms of productivity growth will has already borrowed very much and will have access to additional credit in an easy way. And so this is why we corrected for the size of the firm by measuring leverage within size bins. And actually, we got the same results. So my view, so I know France better than the other countries. My view is that productivity growth at the firm level has very little to do with credit availability and with with the ability of each firm to get credits. Actually, there has never been any form of credit crunch during the 2009 crisis, nor during the euro area crisis. So credit is flowing very easily, and actually those firms that do not perform well, this is related to other reasons, not really to access to credit. This is my interpretation.
We have a question by Harald and then one by Katrin.
Oh yeah, thanks. A very interesting paper. So Agnes, when you look at leverage, you use a time-varying measure, even though you do lag it a few periods. So aren't you concerned of endogeneity still, in the sense that post-crisis, there might be something unobservable about the firm, and only those firms that have a positive unobserved shock are actually able to increase their leverage after the crisis? And that would, of course, give you a spurious non-negative effect of higher leverage, because if you're bad, then in the crisis you wouldn't be able to increase your leverage anyway. So maybe it would be more appropriate to keep the leverage constant.
We have tried that too, to keep the leverage constant, but then the question we have is how long we can take. So the time, the span, because obviously it doesn't make sense to take the leverage in, say, 2000 and to measure the evolution of the firm over the whole period. So then we found it difficult to calibrate the time sample, but we get the same results when we, for instance, we cut it in two pieces and we just take the leverage just before the 2009 crisis and keep it constant over time. But then there is an identification problem, because we are going to we are losing of course, one source of variability, but we can do that, and we've done that actually, and it doesn't change the overall result.
Thank you, Agnes. Carlo?
Just, two quick remarks. First, the result for Italy might be related to the thinner capitalization of Italian firms. So the same amount of leverage might impact more, because leverage tends to be, in a way, more exclusive source of access to finance for Italian firms compared to internal cash flows or other forms of internal finance, due to the thinner capitalization. So this might, I don't know whether you have investigated this characteristic. The second thing is related to the fact that there is relatively little credit constraint. after the crisis. I wonder whether this is, as you probably mentioned, that due to the fact that in a way you're working with a sample of firms that is already selected because they are larger than 10 employees in manufacturing, and this typically are firms that would get access to credit in a crisis compared to startups or micro firms, that this is where most of the credit crunch probably is going to take place. So just these two comments.
Yes, thanks, Carlo. On thin capitalization, since we are measuring leverage as a difference with the country, sector, time bins, so this would not explain why within a bin, when firms have more leverage, they tend to suffer more. It would explain that in Italy you have more impact of leverage, but not the difference within Italy between firms with different leverage. So maybe, yeah. So this is, but also in France, actually, firms are not well capitalized. I think capitalization is, they have used very much leverage, and one reason is the tax distortion. And your second question?
No, but it's just a comment on the potential self-selection of the sample compared to the lack of.
Yeah. So unfortunately, with this kind of data, you cannot work on the extensive margin, because you have no idea of when a firm disappears, you don't know why. So we cannot say anything. Actually, we have small firms in the sample, but we don't have a we cannot identify startups.
Thank you very much, Agnès.